Lisa. Hope you can see and hear. Okay, so we're going to do the last 2 chapters tonight. Okay, and let's see. So we're pretty much decided, everybody, you can, does everybody have my email? Right? So you can email me with what you want to talk about next week. Or if you guys don't come up with anything, don't tell me anything tonight, then we're going to have a real short meeting next week, because I can't tell what you haven't studied or what you don't get. Only you can tell me that. We can go over, you can just come in next week, go over this, go over that, and we can just go by the chapter real quick. Then if you haven't signed up for the test and you want to take them, you need to sign up. Then you got the next couple of weeks to take the test. Bay's going to take his in early November. So what we're going to do in November, the first 3 weeks of November, we're going to go ahead and do book number 3. It's only 6 chapters long. It'll be the easiest. The chapters are such that there's a lot of memorization. One chapter's about being an enrolled agent. One chapter's about what are the rules for electronic filing. One's about what are the rules for power of attorney. One of the chapters is about collections. Another is about what is it? After collections, what? There's appeals, collections, and examinations. And those, you know, what do you do if you're going to do collections? What are your choices? You know, you do an installment agreement. You tell them your client is a poor little old lady who's living on food stamps and eating out of cans in the trash, and tell them that she can't pay. Just kidding. Okay, so where are we going to start? I think we're going to start on page 333.
So Hank, you're going to start part 2 on October 1st?
Yes, is that so? Next week we're going to review everything, and then we're done with part 1. And then the following Tuesday that week is your week to take the test or to study. So you'll have technically 2 weeks to study to get this done. Anybody that wants to have me help them, you can come in here. I can easily make it 2 hours in my day for anybody. You know, in other words, all you got to do is book it up before customers book it up. And there's not that many customers right now. We have the weirdos coming in. People coming in for 3 years, and they only want 3 years done, but they have a file for 10 years. So I'm not sure how that's going to work out for them. Maybe. Okay, so here we go. Page 333. First thing, this you got to know. 709, Form 709 is gift tax form. 706 is a state tax return. Every time there's liable to be a question in there about, and all you got to know is they're going to give you 4 different forms, 709, 706, and 2 other, and they're going to go, which one is the estate tax return form? Which one is the gift tax return? Or, and they'll throw in 5329 or something else like that, you know, that might be right. But if you get that, that's an easy question. Okay? But that's it for sure you got to know. Okay, so on a gift tax return, what is a gift tax return? It's you're giving away some of your money during your lifetime. So if you give it away after your lifetime, that comes from your estate. And we're going to go over that in the next chapter. But if you give it away during your lifetime, what is the general rule? Remember, we've already gone through this. So if you give it away, the basis of the property is the cost adjusted basis of the person that gave away plus their proportion of any of the gift tax. Okay? We're going to go over that one little detail in a little bit. So, you guys weren't, a few days ago, last week, we had a fire right behind, we had, this whole area was blocked off with fire engines and policemen and ambulances. And it was on the news too. A house back here burned down. Okay. So when do you have to file a gift tax return? Here's the rules. Annual exclusion. Okay, a gift tax return is a 709. Is for gifts made unless all gifts are excluded. So if all your gifts are excluded, you don't have to file. So what is the first rule? You can give anybody in the world $15,000 or less, and it doesn't matter, it's excluded. So I have 21 people I see on the street that I just think they're nice people, and I go up and give them a box for 15 grand in it. I can do that as many times as I want. There's no gift tax. Okay? But if I give anybody $16,000, I have to file a gift tax return. I'm going to get to exclude the first $15,000, but I have to file the return. So you're going to have your gross gift is going to be $16,000 minus the exclusion of $15,000. You'd pay tax on $1,000. Okay, what's another deduction for qualified charitable gifts? If all of your gifts are to a qualified charity and you don't have anything else to cause you to have to file a tax return, you don't. So I give $100,000 to my church. Then I don't have to file a gift tax return. Okay? I give my spouse everything. She's already got it, in my case. In case they don't already have it, then you can give your spouse, as long as, I believe she has to be a U.S. citizen, any amount of money. We'll get to the U.S. citizen part later. Okay, these exclusions apply for gifts that are present interest only. What do we mean present interest? I give you a gift, you get it, you now own it. But if I say, I'm going to give you this gift for your lifetime, and then it goes to my kids, that's a present interest. But you're not giving me that house, you're only letting me use it for a long time. And if that's the case, you've got to do a gift tax return. 3 exclusions apply. Any gift of a future interest requires the filing. Okay? So somebody gets to live in it until they die, then it goes to somebody else. But you give it to somebody else, then you might have to follow this. Okay. Tax return. Gifts tax are due April 15th. If you file your regular tax return and ask for extension, you automatically, without filing anything else, get an extension on your gift tax return. If you have an estate tax return due, you have to file your gift tax return by the time you file the estate tax return. But a gift tax return today is due no later than the estate tax return due. But you can always get an extension on your estate tax return that makes it, estate tax return is 9 months from the date of death, whether you get an 8 years extension. We'll go over that later. A calendar year tax return says that you get an extension on your income tax, you also get it on your gift tax. So go to the next page. What's a marital exclusion? A taxpayer does not have to file a gift tax return to report gifts to his spouse. When does this not apply? So, if your spouse is a U.S. citizen, you can give them as much as you want. If your spouse is not, even if they're a resident alien, you can only give them $152,000, okay? Or you got to file a gift tax return. The taxpayer makes any gift of a terminal interest that does not meet the power of appointment. Power of appointment means what? That means you have the power to give it away to somebody. So, if you have a spouse that's a resident alien, She's legally here as a resident, she's paying taxes, doing everything, but she's not a US citizen. You can't give her $1 million. Why do you think that is? She runs off back to wherever she's from and doesn't pay you any taxes, and the government doesn't like that. Okay, charitable gifts. If the only gifts the taxpayer makes are deductible as charity, the taxpayer doesn't have to file. But if you have to file anyway, you have to put the charity gifts on the tax return, then you get to subtract them back off. So I gave $1 million to the church. We'll say 100 grand easier. I gave 100 grand to the church, and I gave my son 16,000. I have 116,000 is the gross amount of my gifts, but the taxable amount of my gift is only that. There's a deduction for that, and you get a 15,000 deduction here for anybody you give money to. So taxable, I only have $1,000. Okay, but I'm supposed to file the tax return. I tried to look up today to find what's the penalty if you don't file this. I couldn't find it anywhere. So what happens if you have a son, you gave him $16,000 and you didn't ever report it? I couldn't find out, but I bet you they don't do a whole lot. Does anybody know what the limit is for your estates nowadays? 11 million, I believe it's $11,180 or something like that. $11 million before you have to worry about anything. Okay.
There's no penalty. Why even bother?
I believe there is a penalty. Well, if you don't file that gift tax return, don't have any paperwork, 20 years later when you're old and you have hit the lottery and now you have $15 million, and you don't have any documentation, well then you got to pay the tax on the whole thing. And for people that have under $10 million, I don't think it's going to matter much. But, okay, our current president is the one that jumped this up to 11 million. Before that, it was only half of that. And just a few years ago, it was down to 1 million, then 2 million, then 4 million, then 5. So somebody could go, let's soak the rich. We want to pay for cleaning up the world. So instead, we're going to start paying anybody that has more than a $5 million estate, they got to pay some tax. I don't know if they'll ever do that, probably not. It's easier, to go down in taxes than it is to go up. But let's just say, Bernie wins the election. He has already said that he wants to raise taxes on the rich. All right, so we don't know. Okay, if a taxpayer makes charitable and non-charitable gifts, all gifts must be included. That's kind of what I said. So if you got to file a gift tax return, you got to put everything on there, all the gifts on there. Then you subtract the part that you can subtract. If the total value of gifts and present interest of any donee is more than $15,000 or less, you don't have to file anything. Oh, good evening. We're on page 334, and we have decided that next week you guys are going to come up with all the things you want me to talk about. So you need to write all that down and have it on a piece of paper so you can remember it, or else you're not going to. And if you can, it would be good if you even did something like email me what you want me to talk about so I can be ready. And if it's something that I can, I could even give you handouts. Okay, so we're going over gift tax returns and then estates today. So we're on page 334, and we're talking about gifts, and we just went over marital exclusion, charitable gifts, filing requirements. And we said if all of your gifts are excluded, you don't have to file. If you give any one person over $15,000, you have to file. If all of your gifts are charity and nothing else, you don't have to file. Let's see. What are the publication 559? That's the publication that goes with this. Excludes the following from taxable gifts. The $15,000 annual exclusion, gifts to your spouse, charitable gifts, political contribution, qualified tuition payments, and medical costs. Okay, so let's go. Tuition and medical costs are going to be the next thing. But I'm going to go. On second thought, I'm going to stay in order. So these are all the things that you get. Now go look on page 335. It goes gift amount. The fair market value of the gift is what it is. So they're going to trick you. They're going to say sometimes they're going to have the fair market value at $10,000 and the basis is at $8,000. Don't pay attention to basis. It's the fair market value of the gift at the time. So you bought some stock for $1,000 10 years ago, but today it's worth $8,000. You're giving away $8,000 in gift. Hello. Anywhere you want. Just push these other people out of your way. How about over here? Yeah, don't get right in front of me. Okay, I got to get back out in front of this. Okay, political contributions. Political contributions are, they're not taxable gifts. Qualified tuition payments are not, and medical expenses that you pay. When you pay tuition payments and medical, they're going to trick you. They're going to say, Hank gave tuition payments of $20,000 to his son. He gave $20,000 to his son to pay for his tuition. And wrong answer. You have to give it to the institution. I gave $20,000 to the University of Hawaii for my son, daughter, a stranger, it doesn't matter. That counts for tuition. I gave medical expenses. I paid Queens Hospital medical expenses for a nice homeless person I met on the street that got ran over. I'm making this up.
Oh, no, but
That would be deductible. If I gave it to the homeless person, it wouldn't be. You have to give it to the hospital or the school. Tuition counts. Books, room, and board do not count. Even though books count if you're an American Opportunities Credit, they don't count here. It's only the books. So what happens if you have a son that's going to a school in California and is still living on campus? He's living in a house with a bunch of other people. You're paying his room and board. It goes over $15,000, you've now given him a taxable gift. I didn't even think about that when I had my kids in college. If you give them over $15,000, what about the money you're giving them for just living expenses, their allowance, or whatever you give it to them for? I don't think many people catch all of these things. In fact, a lot of people don't. Myself included.
So that would be
No. Your room and board is not deductible for education expenses. If you give your child over $15,000, you're supposed to have filed a gift tax return. That was one of the points I'm trying to make. There's a whole lot of people that go over it just little bits that probably never file when they should be. But for your test, if you give your son $17,000, you're supposed to file a gift tax return. You can give him 15, so you get to subtract the 15 from the 17, and you would have a taxable gift of $2,000. And if the gift tax rate, I believe the top rate is 40%, so 40% of 2,000 is what? 800. So you would have to pay $800 of gift tax. But you get an exclusion, so you really wouldn't pay anything. It just,
You have to file once
no, 709. Okay, before you got here, that was the first thing I said to everybody. Make sure you know 709 is gift tax, 706 is excise tax. They're going to ask you one of those two. And that's going to be like a gimme question. Maybe. So, okay, so let's go to 335. So you get the gift amounts, the fair market value, you get exclusion. Okay, so just something that we have an annual exclusion of $15,000 for every gift that you're getting. Okay, so your actual, if you have medical expenses paid on a part, you're paying it to the hospital, you're paying it to the doctor, or you had education, you're paying it to the school, you get to deduct those. Those are exclusions. Look at them, they're different than deductions. Make sure you watch when you do this test. They're gonna, one question will say, what is an exclusion? What is a deduction? So you have a marital deduction, which is everything they give the wife as long as she's a U.S. citizen. And then you have a charitable deduction. All the money you give into the charities are deductible. But you still have to put everything you give away on this one. Okay? So you take the taxable gift for the current year, taxable gift for prior years, add those together, times the tax rate, now it's 40%. But if you gave gifts away 20 years ago, it wasn't 40% back then. It might have been 20, 25%. So now you recalculate the gifts at the current tax. Okay?
But if the balance is 0, you don't have to file.
Yes.
Okay. Just
Okay. So the taxable gifts for the current year, taxable, let's just say. So we gave away $50,000 to our one son. We get to subtract $15,000. So we have a taxable gift this year of $35,000. We had taxable gifts a couple years back to our two daughters. Minus the $15,000, we had $100,000 we gave them. So now our total taxable gifts are $135,000.
you have to add them even though you pay taxes on them.
For the calculation, yes.
Double tax.
You haven't paid tax yet. Okay, now watch. You're looking at this form. You're going down. So you got, that's your taxable gifts to date. Times our tax rate, we're going to say it's 40% right now. So that would be our tax that we owe is $54,000. You with me? But we don't really have to pay that tax because you look down here, it's called the Unified Credit. They've got a new name for it called ACA, but I've always called it the Unified Credit. Okay, so you get to subtract that And what is it? It's 400 something thousand dollars. Tax service. Yes, everybody's gone but me, and I'm in the middle of teaching a class. I don't know where. 9 o'clock. Voice now, how would you?
Do you have to sign
No.
it? Because they haven't been.
I thought that was Lisa, or I wouldn't even have answered. Lisa's the person on this, that's on the big island. Okay, so now, on the next page somewhere, we're gonna see that it doesn't say, but you're gonna, okay, until you get really a high amount, you don't actually pay any tax. Because I'm trying to find what the unified credit is. I believe it's like, okay, in the next chapter, it's $4,417,800. So you don't actually pay any tax because you get a free. You don't pay any tax until after you have $11 million. Okay, so you're not going to pay any tax, but you're just supposed to file this. And you're only doing this for this test. The chances of you having customers that have more than $11 million in their estate is not very big. Unless you're working with a firm that has that kind of clients. Has anybody got any clients, even multimillionaires? I don't think I do. I mean, some of them do because of their house, but not so much. Okay. But does everybody see how this works? What I really want you to do is that you put in all the gifts in. So if I gave $20,000 to the church, I gave $17,000 to my son. I got to put those in, even though I wouldn't pay any tax. But I put it in, fill out the form, send it in. That's what you're supposed to do. In real reality, I was trying to say that I'm not so sure anybody really cares, because you're not really paying any money. But that's the law, that's what you're gonna do, that's what you need to know for the test, that's what you're supposed to do.
So reality, if you gift take over 11 million, then that's.
Then you would,
doing
yeah.
that tax.
Mhm. But here's,
Anything less than that,
you're,
doing the motion.
well, you could give away $1 million this year, $1 million next year, and it starts adding up after a few million.
Well, you have to add all the.
Gifts all through your lifetime.
So, isn't that something filed every year?
If you're giving away that kind of money. But if you only give away 10 grand to your kids once every 10 years, then you don't have to worry about any of this stuff. Or if you don't give away a bunch of money to anybody except the church, then you don't have to worry because you don't even file this. Remember, if you just give away money under $15,000 to any person, you don't have to file. If you just give away money to the church, you don't have to file. If you just gave money to political guys, you don't have to file. If you just gave money for your kids' schooling and you just gave money to medical expenses, you don't have to file. But if you give a bunch of money to more than $15,000 to your parents, you'd have to file. If you did gift splitting, we'll get there at the end of the chapter, you have to file. So what is a gift splitting? Okay, let's say we had one of our children we wanted to give that child $20,000. Okay? If I gave my kid $20,000, 5 of it would be taxable. And technically I would start doing a tax return. If my wife and I gift split, then we'd each be giving the child $10,000 each, and then we have to file the form, but there is no tax because it would be less than 15,000. If you gift split, you can go up to 30,000, 15 and 50. Yes. You can't file a gift tax return joint. There's no such thing.
I know, but if you're filing joint,
There's no such thing as a gift tax return filing joint.
Okay,
You file your personal tax return joint.
it's a separate.
Married filing joint. That's a federal tax return. A gift tax return is never joint. But what you can do, let's say that I'm the only one filing, and we give my son 20 grand, and we give the church 20 grand. We'd have to file, I would file a gift tax return, and my wife would sign that return saying she wants to gift split. She doesn't have anything else. She didn't give away anything. So we had filed, we give 20 grand away to my son, gift splitting, 10 each. We gave 20,000 to the church. That's a deduction. So the tax return, there would be no taxable income. They're not going to ask you the hard stuff. You just basically have to read this. Hopefully you'll get it. These are two of they're going to ask you sort of the easy questions. So, okay, gifts completed when the donor is alive is called inter vivos gifts. I have no clue what that means if I hadn't read it. But it means gifts while you're alive. If you give a gift while you're alive, then it's just, you're subject to the gift tax. Okay? Gift loans are excluded if the aggregate outstanding principal is not more than $10,000. Oh, if you give a gift to somebody, you give a loan to somebody, and the loan is more than $10,000, and they do not give you interest on that loan, you gave them a gift of whatever that interest amount is. So if I loan my son, would you say I loaned him $1 million to go buy a house? It's a loan. He's going to pay me back. I don't charge him any interest. We'll say interest is 4%. 4% of $1 million is 40,000. Okay? Then I gave my son $40,000 is what they're saying. And now I have to file a gift tax return. They're not going to have hard questions, but they might have that on there. If you give out more than $10,000, you loan somebody more than $10,000, the interest you give them is a gift. Okay? Basis of gift of land. The reason I won't see, you see this example 12.2? I'm not going to really go over it but this is what you need to know, because this is one of the questions they're going to ask. Okay, so here's what it is. If you give somebody something, well, I'll just do it. Okay. So I gave somebody some land that cost me, what is it? No, it cost me what? 60,000 was the basis? 60,000 is the basis. The land cost 95,000, right? But I get to always subtract 15,000. So that equals 80,000. Is everybody with me so far? Okay. The 60,000 minus the 95,000 is 35,000. That's the increase. That's the increase over the basis. Increase this far. All right, everybody good now? So 35,000 over 80. I think it's 7/16. But, so that percentage times how much gift tax did they already pay on that property? They had to pay $32,000 of gift tax. Everybody got that? Times this equals almost 16, probably 14. Okay, so you see how we got the 32? It's the 40% times the 80 gets you 32. So 32 is 14,000. So the 32 was 80,000. That's the taxable gift. That's 95 minus the 15. Okay, is 80,000 times 40% is 32,000. That's the gift tax, okay, that you paid on this gift.
Sorry, where you got the 40%?
That's the gift tax, that's the rate. So on your gift tax, you have to pay 40%. Really, that's really high, right? Yeah. Okay, so you had to pay 32,000. So you have to pay 35/80s of this gift tax. You get to add to your basis. So the $60,000 basis plus 14. So we now have a basis of 74,000. That's what the gift is. That's one of the questions. That's one of the hard ones they're going to ask. Do I need to go over it again? Everybody got that? So the basis to the guy that gave away the land, we'll say, was 60,000. The fair market value is 95,000. The difference, 35,000. Okay? The 95,000 minus the 15 is 80,000. They pay 40% tax rate on that 80,000. That's 32,000. So the 32,000 is the amount of taxes. So the percentage of the increase between basis and fair market value is this percentage. And so you get to increase the basis by that amount. That is 14,000. So what is that 14,000 plus the original 60,000? That means your new basis when you give that gift to your whoever it is you're giving them a gift at 74,000. Their basis is 74,000. That's the whole premise of this. Got it? New basis. After you've done this for 15 years in a row, it gets easier. Okay, we've already kind of gone over medical tuition. Remember, it has to be given to the school or the hospital or the doctor, whoever. And you can't write off room, board, or books. Transfers that represent support for a former spouse or child are not gifts. Generally, they're child support, right? So, If you give money for your children, that's child support, that's not a gift. You're supposed to be doing it. Political contributions are not subject to gift tax and are not reported on the tax return. Everybody good with that one? Marital deduction we've already gone over, but you must be a U.S. citizen.
No matter how much you give.
Well, they may get you some other place, but for gift tax, it's not, you don't have to pay gift tax. Now, is there a limit on how much contributions you should get? It depends. My personal opinion is it should be, but there's not necessarily. Okay. Qualified tuition programs. Basically, just read this. So if you give away to a qualified tuition program like a 529 plan, does everybody understand what that is? In another chapter we talked about 529 plans. It's where you give money, you put it into an account so that somebody, let's just say your child, gets to take the money out and use it for his tuition, and it grows tax-free. So we're going to say I put 75 grand into, think of it like an IRA, but it's a 529 plan for my child. It grows to be $120,000. Okay? That doesn't really matter for us. I have to use that $120,000 for my children's education. So if my child was going to a school that charged $30,000 a year, I could take $30,000 a year out to pay my kids' tuition, and for this, you get to actually write off their room and board, their books, supplies, their new computer, but not their new Corvette. Okay, so if 4 years, 120, that would equal $30,000 a year. What does it cost? Does anybody know what it costs to go to UH per year? Less than that, I believe. 16,000. So for a public school, you wouldn't need that much. But if you want to go to the mainland, like a Pepperdine or Santa Clara or Stanford or USC, that might not even be enough. That might be 2 years worth of school. Okay, so here's why they do this. So if you put that 75 and it grew to 120, if you had just put it into a bank account, the difference between the two of them, you'd have been paying taxes on it. Here, if you put it in your 529 and it grows, you don't have to pay tax on the difference. So that's why it's a good deal. But you have to use it. That was a different chapter. All we're talking about now is for gift tax purposes, you can give $5,000 a year for 5 years. That equals $75,000. When I did it, I think it was 11,000. It was way cheap. That was a long time ago. And you could give 55,000 and put it in your kid's name for 5 years. Okay, what does this mean? I can give away 75,000 in 1 year, and it doesn't become gift tax. Everybody understand how that works? Because it's for this one thing. Now, if the first year I put in 75 grand, and in one of the next 4 years, I wanted to put extra 20,000, well then that would trigger a gift tax. Because you can't go any more than the 75 to 5 years. That's equal to your 15,000. Okay, computing gift tax. They're not going to probably ask you about it. If you want to read it and do it, great. But if you'll go to page 338, we'll go to gift splitting. Why would you want to do gift splitting? Because if you do gift splitting, you may not pay any tax. Okay? And all of this had a lot more meaning when the amount of gifts you can give were $1 million, but now that it's up to 11 million, this almost barely even matters at these numbers. Okay, so gift splitting. If both spouses consent, a married couple may consider a gift made by one spouse as from both. So I've already said you cannot. This is another. Oh man, this is going to be a question they're going to ask. Can you both file a joint gift return? No, you cannot file a joint gift return. Only one of you files it. So if you're going to gift split, one of the rules is only one of you gives gifts away. If you're both are giving lots of gifts away, where you both have to file a gift tax return, you don't gift split. Okay? So the rules are, the couple has to be married at the time of the gift, and if they divorce, neither one can get remarried during the year, and they both got to be U.S. citizens. Everybody good with that? So a spouse that simply gives his or her consent. So each spouse must file his own gift tax return. But for gift splitting, I'm the only one that gave away the gifts. My spouse would have to sign my gift tax return saying she didn't give any other gifts and she agrees that we want a gift split. How would that help us? We gave $30,000 to one of my cousins. We gave $22,000 to somebody else, and we gave I don't know, $18,000 to somebody. So if I gave all of this money out and we didn't gift split, then there would be 15,000 taxable there, there'd be 7 there, and there'd be 3 there. Okay, so we'd have about 25,000 of taxable gifts. If we gift split, it's like 15,000 for each of us here, 11,000 for each of us, 9,000 for each of us, and we file a gift tax return, but we don't have any taxable gifts. You're doing this just for the test. The truth is, I don't even file one gift tax return a year. I might file one every 2 or 3 years. Okay.
That 11 million credit, is that
Brand new this year, yeah.
one amount? And, it's not, if you're doing a gift splitting, it's not 22 million, right? It's just flat 11 million credit. Sorry.
No, it's 11,000,000.18.
Per return.
Yeah.
Doesn't matter if it's gift splitting.
So, let's say we have an estate. You have a husband and a wife. The husband passes away. In his estate, he has $6 million of taxable estate. Since he's only got $6 million, he's got $5,180,000 that he didn't even use. If you choose to file an estate tax return, which in this case, let's say the wife has another 6 or 7 million. Okay, right now she has, let's just say she has 6 million also. So their total estate was 12 million, but they've each got different properties, different everything. So she's got 6 million. She'd go, well, why do we even need to bother with filing this? Because they're not going to have to pay any tax. The reason is, you get to carry this 5-1 over to her, so let's see. So you get 11 plus 5180. So now, she only had a $6 million. Why do you have to even bother with all this? After she got that $6 million, she inherited another $6 million from her mother, her father, or somebody. Okay, and then she inherited that $6 million, and all of this is in land. And 10 years later, it doubles in value. So now she's got 20 million. Or even 16. She gets to subtract 16,000 because she filed the gift tax return, didn't have to spend any money, carries it over. It's called portability. This could be a test question, but this is in the next chapter. Somebody was asking me why do you care about all this? This is why. And here's what happened a few years ago. Nobody was filing. Then somebody got some lady had this exact same happen to her. She got a lawyer and sued the CPAs that didn't file this tax return. And all of a sudden, all over everywhere in the internet, this was 5 or 10 years ago, everybody was going, you become liable. You just did malpractice as a CPA. You didn't file this tax return when you could have. And it wouldn't have cost you anything. Might have cost her $500 to get it filed. Everybody see how that's going to work? That's in the next chapter. Well, we're just about there. Okay, gift splitting. So they're not going to make you do problems a lot of this. The one thing that I showed you they might make you do, that's the hard one. They're not going to have but probably about 5 questions on that whole chapter out of your test. And they're probably going, and one of them's going to be, what form is the gift tax form? What is it? 709. Great. So the next chapter is going to be 706. Don't get those mixed up. Okay, so what is the rules for gift splitting? Okay, both spouses have to agree. They have to be married at the time of the gift, and if they get divorced, they can't get remarried. Everybody good with that? And they can't be illegal. Either one of them can't be a non-resident alien, or they can't be an illegal alien. Let's say that. And only, remember what? Only one person files a gift tax return. So, for a period, only one. Your own can file only as a single person. So if both of you gave gifts, you would each have to file your own gift tax return. And we already talked. When do they do? They're due by what? April 15th, or the due date of the estate tax, whichever's earlier. How could that happen? The due date of your tax return every year, let's say, is April 15th, right? The due date of the estate tax return is 9 months from when the person dies, unless you get an extension. So, if the person died on February 1st, 9 months would be before the end of the year. So, you would have to do something, get an extension. Okay? All right, any questions about gifts? Any?
So when a person dies, then a 1049 files.
If they have more than $600 of income.
Okay. And then when is the estate tax filed? Or what?
Okay, a 1031 is going to be, okay, a 1031 is for the estate of a person. That's on the income of the estate. After a person dies, if you died in the middle of the year, up until your date of death, you would have filed a 1040. It'd be your final 1040. After you died, if you had income, I think it's 600, you have to file a 1041 on the income that you have. If you've got an estate, a trust, then you might have a 1041 for the trust that could be for both of those. You understand? A trust would file a 1041 also. So that's your income, okay, from the estate. But an estate tax return is separate than the income. It's the assets that you have. And now, before you really have to file an estate tax return, that's the 11.180 thousand. 11,180,000 is where you have to start filing an estate tax return. That's the gross income. So, even if I have a house that's worth $2 million, but I owe $1.8 million in my mortgage because I have to put the whole $2 million into my estate. Even though I get to subtract the 1.8 million later on when I'm doing the estate, I have to, what is the gross estate? That whole 2 million goes in there. Okay. Does anybody need to go take a bathroom break? Okay, we're good. All right, let's go to the next chapter. Most of the things in that chapter, make sure that you got, were the easy ones. Okay. Sure, they're going to ask you what is the amount of the deduction, the 15,000 deduction, the exclusion amount. They're going to ask you about medical and tuition, and for that they're going to ask you have to give it to the school or the hospital. So if they trick you up, which they might do, and say I gave $20,000 to my kid to pay his tuition, and wrong answer. I gave $17,000 to my nephew to pay for his medical bills, wrong answer. If I gave it to the hospital or the doctor, you're good to go. Okay? All right. So let's go see what is the gross estate. The gross estate is decedent. So what has to happen first? You got to die. The decedent's gross estate includes the fair market value of all property. Remember, we used the word realize and recognize last week and the week before? Everything realized. Okay? Liabilities of the decedent generally do not affect the amount of the gross estate. You don't subtract the liabilities until you've already gotten the gross estate. And then, like those two catchwords that I realized and recognized, this week, when we talk about estate tax, it's deductions and credits. You need to know the two differences and how they work. And we're going to go through that. Okay, joint tenancy with right of survivorship. The gross estate includes the full value of property held as a joint tenant with right of survivorship, except to the extent any party having originally belonged to the other person. Okay, so my mom and I have a bank account that's got $100 grand in it. If mom put the whole 100 grand in, the whole 100 grand goes into her estate. If mom put 80 grand and I put 20 grand, the 20 grand that I put in doesn't go into her estate. Everybody good with that one? Okay. The gross estate includes 50% of the property held as joint tenants. So you guys need to know what we talk about when we say joint tenant with right of survivorship. What does that mean? Two people own something, joint tenancy, and whoever lives the longest gets it. Okay, is that, everybody got that for it? So the GE includes 50% of the property held as joint tenants by spouse or as tenants by the entirety, which is the different. Entirety is different than survivorship. So if that's it, that means you split everything. And what happens, you only count 50% of it. Power of appointment. You get something with a power of appointment, means you get the power to sell it to do with you what you want to do. That's kind of important. The value of property interest over which the decedent had a general power of appointment, that goes in the estate normally. Okay? If you have anything like bonds, notes, even if they're tax exempt, they go into the estate. Pretty much you're going to find everything's going to go. If I own a piece of property, the whole property goes into the estate, no matter if I have a big mortgage on it or not. Later on, you get a deduction for, we're going to see, but you'll get a deduction for the mortgage. Proceeds of an insurance policy given to others by the decedent within 3 years of death are included in the estate. If you have you have an insurance policy and the estate's the beneficiary, it's included in the estate. If you have an insurance policy that you can change anything at any time, it's included in the estate. If you have an insurance policy that has your wife's name as a beneficiary and you can't change it, it's not going in the estate. Pretty much. So if you can change it, it goes in. If you can't, it doesn't. Annuities and survivor benefits include generally the value of annuity receivable by a beneficiary by reason of surviving the decedent. Annuities payable to the decedent. So if I have a 401k or an IRA and the beneficiary on it is my kids or my wife, it still goes in my estate. Okay? But that doesn't mean they don't get it. They get it. But it still counts as part of my estate. Now that these estates are up to 10 million, little stuff like that doesn't, you gotta have a bunch of money before this is gonna start affecting you. You're learning this, my personal opinion, is for this test. If you see anything like this in real life, I do this every year. I go look it up every time anyway. I don't do it, not even once a year. So I go look it up. Just saying.
So if you had a client whose net worth, say 20 million, he dies.
I'd ask him to adopt me.
Would you automatically tell the family to do a appraisal on everything they have?
Yes.
Okay.
First, I would say you need to go get a good lawyer.
Oh, because that's his job to appraise everything?
Well, he would get an appraisal.
Okay.
But you need a really good lawyer. If you got a $20 million estate, and I would probably go, you probably need somebody that knows more about this than me. I would, but I can help. But I don't have any clients with $20 million. I've got just a few clients that are making $500,000.
Partner up with us.
Yeah.
Okay. I'm just wondering.
If you got some $20 million ones, good on you. Tell them if they need to adopt anybody, a nice young girl. Just say, okay. Medical insurance reimbursements due to the decedent and death go into the estate. It doesn't say it here, but a tax refund would go into the estate. Gifts made within 3 years of death are not included in the gross estate if the decedent, except for certain transfers. G, does not include gift taxes paid on gifts within 3 years of death. That might be a question. That's on the edge Okay? Inter vitos transfer. That means transfers while you're still alive, doesn't it? The deed includes assets transferred during life in which the decedent retained at death any of the following. He's got a part of it, a life estate. That means an income interest in possession or the enjoyment of the assets. 5% greater reversionary interest in possession was conditional on surviving the decedent. Just read this stuff. I can't do any better. Interest in a qualified terminable interest property Q-tip. If that is one that's liable to be a question. A Q-tip. That means you've got a qualified terminal interest. Okay, then it just a Q-tip goes in the estate. That's all you need. Kind of. They may have that as one of a multiple choice. Which one of these is not? A Q-tip goes in the estate. Value in gross estate. It's fair market value unless a special valuation rule. Have we already gone over the 6-month rule? This is going to be in there for sure. Okay. You're using the valuation at date of death, fair market value, or the alternate valuation 6 months later. After you can choose either one, but after you choose it, there's no takebacks. After you file the tax return, there's no amended, no nothing. Okay? So, we're going to say the guy died on 1/1 of 18. 6 months later is 7/1 of 18. If he had, this would be 13 million. This would be 12 million. So it would be better to have the lower valuation, right? So he could say, look, it's better if we take the alternate date. If you do it for one thing, you have to do it for all of them. There's a rule, okay, got that? So, this is what they were valued at when he died. 6 months later, this is what they were valued at. So he would better off with the alternate date. He could do that. But he can't pick and choose back and forth. Now, what happened on this one? If he sold it on 4/1/18. So, since he sold it before the 6 months was up, you take the date, what was the fair market value on the date that he sold it. Since it's the same as both of them, it'd still be 12. Okay, one of the rules is for you to use the alternate method, it has to give you a lower tax. So if this number is higher than this number, you wouldn't use it. We haven't gotten to that page yet. But this is something that's, this problem, just like this, is on there every year. Everybody good with it? Understand? Okay, I've already said the alternate valuation is irrevocable after you choose it. You got to stay with it. You can only use it if they give you a lower value, reduces the value of the gross estate. You can only use them 6 months. Assets, the value of which is affected by mere lapse of time or valued at the date of the decedent's death, but adjusted is made for value change from other than mere lapse of time. I've been doing this for 10 years and I don't really know what that means. Might be just like all wills or things like that. Deduction and credits. This is the big gorilla in the room. There's deductions, credits. You got to know these two. We'll call it the big D and the big C. Okay? Deductions. Things first you get the overall gross estate. You put everything in at its fair market value. Now you get to start subtracting things. Okay? The expenses for selling property of an estate are deductible if the sale is necessary to, here's a whole list of things. Pay the debts. You got to sell land so you can pay the debts, pay the taxes and all that stuff. Then you get to deduct all the expenses of selling the land. There's a whole list there. There's 1 through 5. Just read them. Claim against the estate, not including debts of the decedent, are deductible. Okay. First, administrative and funeral expenses are deductible. So you can write off all the you have an administrator. He wants $2,000 a month. And that's a reason. Say in this case, that's a reasonable amount. If you got a $12 to $20 million estate, $2,000 a month is probably cheap. Depending on how much work you got to do. But you can write off the administrator, the lawyer fees, okay, the accountant fees. You get to jack. If you got somebody with $20 million, you can jack your fees up on them. They won't even notice.
Don't you have to report it to the courts or show
Yeah.
paperwork?
Yeah, you got to be able to document what somebody might complain. Okay, so what are the kind of expenses? Administrative, funeral expenses. So you can't write off a funeral expense on the final tax return on a 1041, but you can write it off here. Okay, then medical expenses paid within the first year. You can either take them here or you can take them on the final tax return, but you can't take them both. Everybody pretty much, we've already gone over, we're going over final tax returns. Unpaid mortgages on property are deductible if the value of the decedent's interest is included. So you have a house worth $4 million, you've got a $1 million mortgage, you get to subtract the $1 million mortgage. Okay. Yeah, you're going to get to write off all your expenses that are reasonable that have to do with the estate. And which are going to be the administrator, the lawyer fees, the accountant fees. On all your property, if you have a property a rental property, you need to have a management company. You're going to write off all that kind of stuff. Okay, state inheritance tax are deductible from the gross estate. So you pay state inheritance tax. I believe we in Hawaii have a state inheritance tax. So you'd also get to take that off. It's a deduction. A couple of years ago, it used to be a credit, maybe 4 years or 5. And when it changed from one side to the other, it was a big deal. And it was on the test every year. Now, not so much. But you need to know that it's a deduction. Okay? Casualty and theft losses incurred during the settlement of the estate. So, if it was a casualty and theft loss that happened before he died, you don't get to put that on. But if the guy died 2 months ago and he has a house in the Bahamas that just after he passed away, now all of that casualty loss can go. Okay, what else have we got? Charitable contributions. Bequest to charitable organizations. When I pass away, I want my estate to give $1 million to the Catholic Church, or the Baptist Church, or the Buddhas, or somebody's. Doesn't matter. It's okay. What you can't do, so any charity is good. It can be, I don't want to make jokes. Okay. Trump is put in the trash can charity. Okay. While alive, anything you make for charity is not part of this. Okay? So I gave charity while I was alive to the church. That goes on my final tax return. Okay? But that's different. Okay, here's where it gets tricky. I have a bequest, but I give it to a person, and it's in the terms of a will, and it's for a specific piece of money, and it's paid in 3 or fewer times to my son, my daughter, something like that. That kind of a bequest is not a tax, is not a deduction. I can't always explain that part really well, but I know that they're going to have that in there somewhere. But the rules are that kind of a bequest that's doesn't count. Marital transfers. If your wife is a U.S. citizen, she must be a U.S. citizen when the estate tax return is filed. So, she's not a U.S. citizen today. You go out and tell her that she wants to become a U.S. citizen really quick. And if she gets to be a U.S. citizen before this is filed, and you can remember, you also can ask for an extension. You get a year's extension. She's still good. If not, you might want to put all of her money, is called a Q-tip. A marital deduction is allowed for transfers of Q-tips. These transfers allow a marital deduction where the recipient spouse is not entitled to designate which parties will eventually receive the property. So, you put $5 million into a Q-tip, and she gets all the income while she's alive. And then the income goes to your son. She doesn't get to choose where the income goes. She can't go take the money out and send it to her hometown in Timbuktu or something. That's why this whole thing is you got to be a U.S. citizen so that the government always can get their money. Because if a lot of times half of your estate might go to your wife. And so that by the time you deduct all of that, then there's nothing left to pay tax on. So the government doesn't get any money. But now the wife has a big estate. 11 million is a really big estate. But then, so if the wife passed away, then the government gets all the tax. So the wife didn't have, unless she marries somebody new. Then he could actually get this. So she got married to somebody, she's already gotten her first pile of money, tax-free. Now she has a big pile of money, tax-free. She's a young wife, and she marries a guy that's got another pile of money. He dies, she now gets another pile of money. So now she's got close to $10 million. If she, let's just say it's $15 million. So if she passed away without another husband, then now that whole $15 million is taxed, and now the government's finally going to get the money out Unless she gives it to the charity for her new dog. She bought a brand new poodle and she put it in a charity and the dog gets the money. I'm joking. Okay, so is everybody, now we've gone through, these are all deductions. These are not credits. Everybody good?
Mm-hmm.
A Q-tip is defined as property that passes from the decedent in which the surviving spouse has a qualified income interest for life and to which an election applies. So, okay, so she's going to get that money for life.
What does it mean, election?
I don't know. The spouse has a qualified income interest for life and all the income. She can't have the power to, I don't know. So she can't have any power to do anything with any of that money in the Q-tip, okay, while she's living. Why did it have to go to the Q-tip? Because she wasn't a U.S. citizen. If she was a U.S. citizen, you don't even need that. Now we're going to go to the other one. So does everybody get, these are deductions. You start with the gross estate. Then you subtract the deductions. You have taxable estate. From your taxable estate, you calculate the tax. We'll say you've got 12 mil. 40%. Is 4.8 million. Okay. Now she gets to subtract the credits. What credits? I'm glad you guys asked. This is, you got to know the difference in which ones, because they're going to trick you. They're going to say, what are the credits? And they're going to put some of the debits in there, or the deductions in there.
Taxable estate is like 12 million?
Yes.
What's the 48 million?
Times 40%.
Oh.
Yes. 40% is going to be the standard tax that's right now that applies. And if they give you any problems at all, 40% is the amount of tax they're going to give you. They're going to probably just say the tax rate is 40%. If they don't, you've got to figure it's 40%. Okay, so you started with the gross estate. You subtracted all the deductions. That would have been all the mortgages, all the amount that you paid for administration, lawyer fees, well, both administration fees. What you paid for all the expenses that you had that were deductible expenses, all the money you gave to charity, okay, and any marital transfer. So that she could have had a $40 million estate, but you gave $30 million. Let's see, she had a $42 million estate, and she gave $42 million to all of her deductions. So now she's down to a taxable estate of only $12 million. Poor thing. So now we go to the credits. What are the credits? The first is, they call it the uniform credit in all the other years. Now they want to call it the applicable credit amount. It's still the same amount. Think of it as, it's more or less, it's the amount you get to deduct. Think of the 11.18. It almost comes to this exact amount, because part of the 40%, it's not exactly 40%. 40% times that would be a little different. 44,000, 20, a few thousand different. because of the first $10,000 is taxed at a lower rate, and then so the credits you get to deduct, the first one is the unified credit or the ACA credit, and it's based on that 11.18 million that is you get to subtract from your taxable gross estate. Okay, besides that, what other kind? There's a credit for death taxes paid to foreign governments, gift tax paid on gifts. If you've already paid a bunch of gift tax, we were showing before, you would have had to have had an estate above the $11,000 before you would have paid any gift tax. But you could have paid gift tax 5 or 10 years ago, 20 years ago. The estate wasn't 11 million back then, it was only 1 million, 2 million, 3 million. They were a lot smaller amounts, and you could have already been paying. So you get to subtract the gift tax from the taxes you got to pay now. The biggest gorilla in the room is the 4.417800. Okay. So we've already got credit paid on other taxes, and if you've had any, you might have this. They're not going to give you this in a problem. Prior transfers. If you would have inherited money, so let's just say your dad, 5, 10 years ago, 20 years ago, he was worth $50 million or $10 million, and he paid tax in the last 10 years on his estate, you get to subtract that. Or if they die within 2 years after you're dead. They're only going to ask you that as a multiple choice question. They're not going to make you do a problem like that. Okay, and then it says what are the amounts? It's the lesser of the estate paid on the prior transfer, or the amount which the estates increase the estimated tax. I doubt they'll even ask that. Okay, if beneficiaries may take a deduction for the estate tax paid on income earned before death but received afterwards, that would be on the 1041. So you might get to write off your estate tax. And it would be, the deduction is taken on the Schedule A. Okay, so, and I've already shown you the example of the portability. So if you had a guy that passed away, his wife didn't use all of the gift tax, she could carry that over and use it on hers. Remember? Okay. That's called portability. And it's on page 355, under credits, it's number under A, it's A3. Okay, on page 356, estate tax payment and return. Okay, so let's just say you got to pay your estate tax. How long do you have to pay it? Oh man, these guys want us to actually pay this. You only got 12 to 15 million. Okay, the executor is required to file the 706. Who? The executor. What happens if they don't file it? They can be held responsible. I can't know what the penalties are. I couldn't find them. But the executor could be responsible. Something else, I'm not sure it's in here. we have a state tax of $80,000, and they gave it out to 4 different people. Let's just say the estate, they gave it out. So he got 2 million. He got 8 million. This guy over here got 50,000. And this is the administrator. He's the ad. So, if for whatever reason this guy doesn't pay, the executor, the administrator of all this doesn't pay, he could be liable for the whole 80,000. Each of the beneficiaries of this estate is liable up to the amount they got. So this guy that only got 50 grand, he can't be made to pay more than 50 grand. These guys up here with this 8 million and 2 million, they can be made to pay the whole 80,000 if everybody else runs away. But really the guy that's going to get in trouble is this one up here. There is a profession, these guys that do this for a living, and they probably pretty much know what they're doing. Okay, so the estate tax payment and return. So the return due date. This is another question they always ask. What is the return due date? 9 months after the date of death. The extension of up to 6 months may be granted. That's for the tax return. The time for payment may be expended for a year past the due date. For reasonable causes, it can be extended to 10 years. What do you think would be a reasonable cause? In 2008, the stock market fell in half. And you had a bunch of debts, and so you needed a bunch of time to get everything sold and get it all straightened out. Especially if you had property places all over the world, all over just the United States. You've got a big problem with paying state tax in different states. Getting everything straightened out, it could take years to get all this. If it's all in one state and it's all in cash, no problem, just pay them. But in reality, it's not usually that way. Does that make sense to everybody? So what you need to know is you get a year to pay them, and you can have an extra year, and you can have up to an extra 10 years. That's the question that's sometime on the test.
The extension is the next year.
Extension is 9 months from the date of death. The extension is 6 months past that. That's an extension to file. Payment. Okay? Time for payment may be extended for a period after the due date. For reasonable cause, it could be up to 10 years. That's on page 356 under payment due date.
Sorry, the due date is the original due date or the extended due date?
Yes.
Which one?
Yes. Both. If you didn't get an extension, it would be the original.
Okay, so if you got an extension, it's the extended due
Yeah,
date.
I don't. Okay, the assessment period. Generally, periods of assessment. What do we mean? For the government, after you filed all this stuff, they got 3 years normally to go audit you, just like normal. But they also, it says, the assessment period extension an additional 4th year on transferees for transfers. If they don't give you the money for several more years, they got a 4th year to go after you, the person that gets the money or the property or the whatever. And that's a quick question. So it's normally 3 years, but for they get an extra year for transfers, and probably there's a lot of transfers. Taxes charged to property. The executor is ultimately liable for payment of the taxes. If he doesn't, he could be liable. Oh man. Page 356 on number 4, tax charges to property. So, if the tax is part of the estate is distributed or is paid out, remember I was showing you over here, you're only liable up to the amount of money you got, but any one of those people could be liable for the whole thing.
Do they get it?
Yeah, if they get it, you know what you mean when they get it. Okay, closely held businesses. An estate that is a substantial interest in a closely held business may be allowed to delay payment of part of their estate tax. Why is that? A closely held business is hard to sell. You can't sell it because, nobody's going to want to buy in to whether it's you as a stranger with a bunch of family members, and they'll all vote together. Okay, so what is the rule? Closely held is 45 or fewer shareholders or 25 or more value in the voting stock. That would be closely held. A partnership has got the same rules. So a corporation or a partnership is considered closely held in this case. Everybody, will they ask you all that? I don't know. But that might be a multiple choice. Okay, consistent basis reporting. So what does that mean? When you file an estate tax return now, the estate tax has to give you a form if you're one of the beneficiaries, and they got to give it to the IRS. They got to file it. So what does that mean? If we value that property at $6 million, then you've got to value it at $6 million for your basis, and then when you sell it. So the estate's got it $6 million. So you better put this as basis when you sell that property, $6 million. And there's a form. This is going to be another little thing you need to know, that name. What is the form number, guys? 8971. What's that? You and B or C? You see anything that says 8971. What do you got to do? They got to send you a copy, and they got to put a copy with their estate tax return. And what does that do? That's the same thing as if you're selling a business. You're buying a business from some company like a sole proprietorship. You have to list all the assets and how much they're valued. And both the guy that's buying the company and the guy that's selling the company has got to get the same form. They've got to have both signed, send it in. And I don't know if it's the same number as this or not. I filled one out a long time ago. I haven't done one lately.
What's the difference between this form and actually one form? I thought,
This form is just listing of the assets from an estate. An estate doesn't file a K-1. Yes, but a 1041 is not this. This is 706. This does not have anything to do with the income from the estate. This is just the tax on the value of the estate.
So this,
You would have to very likely, though, if you've got millions of dollars worth of assets, you probably have to file an estate tax return because the guy's probably still got money coming in to the estate afterwards. So if I had $5 million of stocks, the stocks, the $5 million would go into the estate. And let's just say that I got $200,000 worth of dividends. The dividends, the $200,000 would go into the estate, but I would also have to pay income tax on the $200,000 of dividends, and it would be either my 1041 that would do that on my estate, or it would go into my trust, which would then file the same 1041. Well, somebody, if you had a bunch of income, somebody's got to pay income tax on it, and it goes into the state, can be state income tax. I think somewhere I've missed generation skipping tax. Is it on the next page?
yes.
Huh? Huh. That's the last thing we got, probably. Okay, generation skipping tax. So here's the first thing that they're gonna ask you. If you've got either estate tax or you have gift tax, do you also have to pay generation skipping tax? The answer is yes, you do. Think of gift tax return. You gotta file and you gotta pay them so much money. Well, you'd have to do the same thing on a generation skipping tax. What is a generation skipping tax? Glad you guys asked. You wanna know that. Granddad, dad, son. I actually had, the best man at my wedding actually had this. He's a trust fund baby. His dad made a giant trust. His dad had the first Coors distributorship in the state of Texas, and for over 10 years, the only Coors distributorship. You know how big Texas is? It's huge. You know how those people like to drink beer? Huge. Really huge. People would drive 600 miles to his, where he had this place, and fill up their car trunk with Coors and carry it back to wherever they were from and sell it for double. Anyway, so he retired, made a big trust, and it went to his sons, and then it really went to the grandsons. So the sons are, as long as they're living, they're all still living, they get to use the money. But then when they die out, the money goes to the grandkids. Okay? So what does this mean for everybody? They've got it so that if you do this, then the government, if you give it all to this guy and then he gives it to him, they get more taxes. But if you do this, well, then they don't get as much money. So to stop that, or to at least get more taxes, they came out with generation skipping tax. So there's a tax, and it's either one, this is relatives. If it's not your relatives, they've got it by anywhere between 37 and a half years and 62 and a half years. So if you're let's just say 60 years old, and you give it to your friend, whoever that is, that's 40 years younger than you have got a generation skipping tax, and you have to pay this. So now what you need to know is, you skip a generation here, that's for relatives. If it's not a relative and you do the same, that's more than 37 and a half years younger, you've now skipped a generation. I don't know what happens if you're more than 62. It doesn't apply if it's your child. May and I have a good friend that he had children when he was in his 50s or 60s. No, wait, his 60s. 2 kids.
There was a lady that in her 70s that actually. That was true.
Okay, anyway. So, there's 3 kinds of skip. A direct skip, taxable distribution, taxable termination. You need to know these 3. And they may ask you some combination. So a direct skip is when you go from granddad to the grandchild, or more than 37 and a half years. So what do they have to do? They've got to pay another tax, just like the gift tax.
From granddad to
Grandchild. Yeah. But remember, we still got the $11 million. So you got to be a kind of a rich guy before this thing's going to matter. Okay, so a direct skip is that. A taxable distribution. A taxable distribution is when you, let's just say you've got a trust. And in the trust, there's, the granddad puts the money in, it can go to the son, it can go to the grandson. If only the son takes the money out of the trust, there's no generation skipping. But if the son takes some out and then then the grandson starts taking out, that the grandson takes out is generation skipping. It's a distribution and you gotta pay tax on it. Okay? The third one is taxable termination. It's when the dad dies and then the son gets it. The taxable termination is a termination of interest in property held in trust. Immediately after the termination, a non-skip person has an interest in the property. That person dies. Then all of a sudden, the only people that have it is the young kids, the grandkids. Now you've got, so all the money they get out, they got to pay tax on. The generation skipping trust approximates the maximum federal estate tax. What was that? We've been talking about it all along. 40%. So these guys, they are getting whacked a little bit. I don't feel sorry for people that have $12 million or billions. I wish I had $12